more accurate in forecasting recoveries than unfortunately economists. All you have to do is take away the consumer's confidence from the expectations, the overall versus the expectations. When you look at that, you see that orange line begins to move up well before the economy moves up, and it's suggesting that the U.S. has another couple quarters of fairly strong growth ahead of it. But then again, the expectations at this point are for U.S. consumption of 2%. Now, I'm going to argue that that's too weak. And one of the reasons is that the savings rate, as was suggested, is beginning to fall because personal income is recovering. And inflation is so low, and if you look at inflation volatility over time, and we're probably looking at core inflation moving below or close to zero in the United States, when that's very low, consumers get very comfortable with the situation, as long as you're not in a deflationary Japan-like scenario, and you begin to see a lift, and that would be forecasting, this katana effect would be forecasting about a 4% growth rate for consumption. I have 3% here. As I said, the savings rate has peaked, and we can see why is that? Because income, and this is where I want to talk about the stock of wealth and the income distribution in the U.S., because the wealthy people are fully employed now, their wealth is recovering, and they're spending again. And they do make a difference, as I'll show you in the next couple slides here. We can see that the jobless claims have picked up, and with that, we've gotten a pickup in the S&P, and that generally does happen. So the wealth that we got, what, 15 trillion trimmed off, 7 or 8 trillion has been recovered now, and that has begun to stabilize expectations in the wealth effect. The wealth effect has moved from negative to positive now, and that's what gives you your big amplitudes in consumption. When I look at this housing wealth in the United States, I think, it was very popular to say the U.S. household is absolutely bankrupt. They paper wall their homes with flat screen TVs. They're up to their gills in debt. Well, yeah, the liabilities of the household have risen to about 15 to 17 trillion, and the consumer credit has been paid down. But the big hit was that blue line, is that you see that housing wealth that had gotten up around $55 trillion, dropped to $40 trillion, and now has begun to recover again. It is in recovery mode. Housing prices are moving up. The stock market, I would argue, has bottomed, and that's important. Household debt levels, debt service levels have declined from high rates. Those are beginning to come down as well. That leaves more money in your pocket to spend. But the real thing I want to talk about is this income distribution. When we look at what's happened and what's likely to go forward, I don't think this is going to hold up, but it is operational for now. The top chart shows you financial deregulation, and as you deregulate, that blue line goes up. And what happens with that is that your relative wages in financial services to those in other industries rises dramatically. And that is a situation that continues today. Remember, we've been hearing about the great payouts on Wall Street, the significant rises coming back in the financial sector. And if we look at that bottom sheet, this is what really gets you. What goes along with that is that the top 1% account for 20% of income. You know, it's not nice to say, and there may be a problem in the US, but the top 1% or 10% or 20% are fully employed, making money, feeling richer, and they control 60, 70% of consumption, then consumption is going to move up. And there's going to be somewhat of a, to use a phrase I don't like, a trickle-down situation. And indeed, when we look at this, the rich are fully employed. When I take the unemployment rates by decile, the top 1% or top 10% have an unemployment rate of 3%. The 80 to 90th percentile have an unemployment rate of 4%. The 70 to 80th percentile have an unemployment rate of 5%. That group is fully employed. They dominate consumption. 1% controls 20% of the income and spending. That's why you're seeing your high-end move up so well here, your luxury sales beginning to pick up. And this does create a momentum and create growth overall. When I look at the debt situation, and people keep telling me, yeah, but the U.S. consumer is so indebted and he's going to fall flat on his face. This is the problem with averages. When I look at the top 10%, see what we have is quintiles up to the far right, and then it's the 80th to 90th percent richest, and then the 90th to 100% richest. Their debt servicing ratios are very low, particularly that top 10 percentile. He has money and he's ready to spend. He's in recovery mode. He's been in recovery mode ever since March of last year. And when we look at the ROB index, this is the index of luxury products versus those against the MSCI for the world. What we see is that these rich guys are already spending. Your high-end consumer is back in the game. That will begin to trickle down. That will create momentum. And even if this falls apart in 2011, it's going to stay here for the next couple of quarters. And the longer it stays, the more momentum, and this broadens out across the consumer sectors as well. With that, I think I've used my time, and I'll stop there.